Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I offer in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, everyone. Ira Epstein with your metals market update for this Thursday, and this is the 11th of May, 2017, about 2:20 p.m. Central Daylight Time. You know, we've all been watching the hearings going on as the new FBI acting director is getting grilled, and many of the different generals are getting grilled, and the witch hunt is on. What did the president do? Should he have fired Comey? Should not? That's influenced the metal markets. More important is there was a report this morning that, again, the markets are looking, or the military is looking at North Korea, and word is that they're getting ready to do a nuclear test, and word is that they're getting ready to do another ICBM test. Now, is it just hearsay? What is it really? I don't know. But it's interesting because when the news did come out, we saw that the gold market did turn around off these lows and rally off of them about $9, and it closed good today. It closed in the 1224.20 area. That's a pretty darn good close, and it's still gaining as the market finished there. At the same time, we saw the dollar slip a little bit. We saw the Japanese yen get a bid, and if you look at the bonds and the notes, they got a bid. So I think that news, I'm not saying it's real news, I'm saying the news worked its way through the market, and traders that are up on that watched it. Now, if you look at the weekly chart, I have not changed my opinion. By the way, for the week, gold's down $1.50, $1.40 right now. So it's not as though gold is falling apart this week. But what you do have on the chart is it's come down. The question has been, do you go back to the 100-day average, or do you lift back up? Now, to get back up here, you have to get back up another $9, $10 up to $1235.50 to get back to that 18-week moving average of closes. Right now, the 100-week average is $1208.60. On the daily chart, you had a low close yesterday of $1216.10, and we're bouncing away from all this right now over the past day or two, and we're up to a $1225.30 right now. Okay, but you're still in a down thrust. When we look at the chart action, something happened today. You have an outside day up. It doesn't look like it. You're not going to get a lot of fanfare talking to you about it, but that's what you have. So two events happen from that. First, if you take out today's lows tomorrow, you create what's called a bull trap in the market, and markets often reach for the next level to the downside, and we'll discuss that in a minute. If it doesn't take it out, you have a swing line low that is in place there, and that changes the swing line pattern on the chart. Let me explain it. The swing lines, and by the way, these are available in charting software from the Linn and Associates, my versions of it. You've got higher lows, now a higher high. So the swing line has turned positive. If you take a look at where the market rallied to on the daily chart, have I not been telling you that that's the first move under the 100-day? It doesn't often stay either under it or above it on the first challenges. Later on, it can decide what to do. But you have to admit, this market's been over this 100-day moving average of closes. It had a brief period like that here, and then it came back to life. I'm sure that everybody'd get excited if from here the market rallied back into this general area of the combination at 1259, the 200-day average, and the 100. I read reports today from a number of different firms. I think Credit Suisse is talking that they think, their analyst, at least one of them, thinks 1,400 by year end. I read Goldman and some of the other companies, they think the 1260s are where the market's going to go back to as the year moves on. Hard to tell, but the Goldman number, at least I can relate to. I don't know what would put it up to 1,400 just now, but I do in a funny way. If the North fires another set of ballistic missiles, I'm not just saying one, let's assume they start tests. If they run a nuclear test, I don't know what that does, but with all the military there, it's like begging a problem. I don't know what that problem would be. I don't know if the U.S. could do it on its own. But it's the type of thing that gold normally rallies on. That's all I can point out. In terms of Bollinger Bands, you were running the lower Bollinger Bands. You're no longer doing that. So that's pretty well off the table. Momentum, you still have the embedded reading. So if you want to add fuel to the fire, you have to lose this to get this market to rally. Otherwise, these rallies are just that. They're rallies in a market that's got overall bearishness about it. Now, I left on here the arrow showing you the downside you had, but with today's outside day up, it changes everything that fast. So that's not an error. I wanted you to see how it all comes together. If you look at the gold-silver ratio, I've had it in an upthrust, and I can actually now say that I can switch this around now to say we've begun a down thrust, that the 75.69 has got the makings of a peak. Now, what I would like to see is another bump in the road up and then it coming down to say, yeah, I'm going to be doing that line. But as you went up this way, you've now, I think, reached the point where you've reached where the rubber band is ready to snap on that particular trade. In the gold ETF, look where you're holding. The 100-day average. You did not have an outside day up, so the arrows stay down. That is why I wanted to leave them on that one chart. I wanted you to see how I work with them. Also, look at what's happened. You have not yet had your bearish crossover. I expect it to happen here because the 18 is still over the 200, and when you come back to the futures, you had that crossover, and you didn't make a new low off of it. So pretty interesting there, too. What did I say about the miners yesterday? This is yesterday's action. And I said, I think this market, with the lost embedded reading, is going to make a run for the 18-day average, might even make a run for the 100, to be honest. And it's out of its downtrend. That does not mean it's in an uptrend yet. But if it closes like this, one will argue it is in an uptrend again, although the risk-reward is pretty rough. Because if you bought it here, you're not wrong, to 21.22. And the resistance is waiting just about 49 cents higher at 22.80, the 100-day moving average of closes. The important thing is the miners led the break down. They were acting terrible and the futures were acting strong. They bottomed ahead of the futures market, if you will, the material market, and they're on their way up at this point in time. In the silver market, you can see you've still got the embedded reading. You did not have a day where the market lost that reading, nor did you have an outside day. So it's still very much in the bear camp. You had your bearish crossover. I don't think you'd really gained a lot from it from the day that occurred. In the SLV ETF, you're trying to turn a little bit the momentum in the embedded reading. It's the first time that we're seeing where instead of just laying flat, the red line's starting to pick its head up a little bit. You'd have to take out in this chart 1551 to break the swing line and take it back to neutral. But the real play comes in if you lose the embedded reading, because then from here, I would not be surprised for price and the 18-day average to come together. In the copper market, today was a run at that 18-day average, and it failed miserably. Now, you just have an oversold market, but it got all the way up there and bang. During the whole day, it just kept falling back, back, back. That's a 5-cent break. It's a big move from the high to the low today. So it just didn't go anywhere, but it took the market out of the downtrend. So there can be an argument here that maybe this 250 area is offering a value zone. In the platinum market, at first I liked the short side of this market. Then I began to dislike it as I noticed that as the market fell during the day, you still were getting the market out of its embedded reading. The stochastic had the red line moving back over 20. Yesterday the numbers were nicely going sideways under 20, and today all of a sudden that's not the case. That's a warning sign. Yeah, it could fall back tomorrow. Why wait for tomorrow? If you had any money on the trade from being a short-term trader in it, probably a time that I think some of the people grabbed it. That is a warning sign. And if it stays unembedded, 930, 890, or wherever that 18-day average is tomorrow could be a target. The palladium market is just plain stuck, going sideways in a Bollinger Band that is going sideways at the 18-day average of closes. Momentum is still drifting lower, and that's why the market's unable to do any rally. If you look at the dollar index, it's still giving you a bit of a rally, but when I look at the value at 72, it's overbought. It's come right on here from 90, let's call it 98.35 all the way up to 99.76. All I'm looking for in the market is the 99.94 level. So you're getting close to an area where I thought resistance would come in. I'll call this market overbought, still has upside momentum, not really trending. A bounce off of a low, and we'll see where that goes. And if, again, we're at May 11th, this market's building in right now what? It's building in rate hikes in June for the U.S. dollar, so that's something to watch. If you like how I'm talking about this, there's so much more in what my firm writes daily on all these markets. Now, you don't have to get all this data. We allow you to pick and choose to see what it is. This is written by grain pros, metal pros, currency pros. Gives you an idea what's going on there. You're a sugar or a cotton trader, you got to love what we put out in information. Why? Because we represent hedge firms, commercial firms in different parts of this industry. To get this and see what our customers get, because you can get it too, not for very long though, call us at 866-973-2077. You can go to our website. You'll see a carousel of free offers. But this is what our clients get, or people that buy research from us. If you haven't tried this, I think you should. I think you'll be surprised. Are you an options trader? A lot of option strategies thrown here. I'd like to know who's buying how many options in the grain pits. Who's doing what? What are they trying to accomplish? Are people write about it and talk about it because they're in those pits? Yeah, options are still traded mainly in the pits, in the corn, the wheat, and all those type of different vehicles. And we have brokers actually doing those fills. Click up here if you watch us on YouTube. You can see the icon under us where it says, click here for Ira's free offers. Everything will come up. Choose what you want, and we'll put it in your mailbox. I'm Ira Epstein. You have a great day.